Hi, everyone. It's great to be here. My name is Peled, and I've been active in the industry for almost 10 years. I'm the co-founder of Orbs, a public blockchain infrastructure based on proof of stake, and I'm also the co-founder of Hexa Group, the largest blockchain investment group in Israel. Our main thesis was investing in infrastructure projects ever since meeting Vitalik in Tel Aviv in 2013. The topic for my talk today is the paradox of blockchain monetization. This topic is very close to my heart because I'm very passionate about creating value that is sustainable and not based on hype. I've been trying to build a blockchain project with successful monetization for a long time, and it's not such an easy task. In this talk, I'm going to show you why monetization of infrastructure, in particular, is difficult, and how the infrastructure can adapt itself to create additional revenue channels. Revenue is essential for making a venture sustainable. This sentence is very straightforward, especially if you're coming from the traditional world. Every traditional company has to make money, or else it will eventually run out of money. The same is also true for blockchain ventures. A venture that doesn't have any revenue will eventually run out of money and shut down. If we translate this to tokens, if your token economy doesn't have constant organic demand, the economy will never be sustainable. In 2017 and 2018, hundreds of projects raised more than $10 billion in ICOs, and the majority of which ran out of money and disappeared. But a company that makes revenue can live forever. So let's take a look at some actual data from the last 90 days to gain some perspective. This graph comes from Token Terminal and shows the leaderboard for blockchain protocols in terms of revenue. Ethereum is the clear winner at the top with $1.4 billion in revenue during the last 3 months. This revenue comes from transaction fees paid by users for running smart contracts. Number 2, with about half the revenue, is the play-to-earn game Axie Infinity. And number 3 is OpenSea, the general-purpose NFT marketplace where you can trade your CryptoPunks and other NFTs. So what can we learn from this graph? First of all, we know that usage on blockchain is difficult. And many popular protocols have almost zero actual use. Generating revenue is even harder, and only a couple of unicorns manage to do it well. Second, it's also clear that we're very early in the game. Traditional traded companies will never thrive without making any revenue. Yet, in our industry, protocols can reach very high valuations without demonstrating a positive business model. I believe that this will change over time as the market matures and projects that generate revenue will stand out. Third, if you look at this graph in, let's say, 18 months' time, it will probably show a different group of projects. Most of these success stories are fairly recent, and it's anyone's game at this point. There isn't a clear method that consistently works for monetization. My last conclusion, and probably the most important one, is that value is shifting from the L1, L2 infrastructure layer to the application layer. 80% of the projects in the previous graph I showed you are actually applications. And the most interesting one The most interesting project on that graph was number 2, Axie Infinity. This NFT game launched in 2018, but only recently started exploding. The game has impressive metrics, like 1.2 million daily active users, 2 billion total NFT sales, 250 million in-game revenues. Most of the protocol revenue is generated in-game through the marketplace, where players can buy and sell Axie's NFTs. Axie Infinity is an application. You would normally expect it to run on top of some infrastructure. And indeed, when it launched in 2018, Axie contracts were running on Ethereum mainnet. Since high Ethereum fees were obviously a barrier for players, Sky Mavis, the Axie core team, intended to run on a cheaper L2 and were quite serious about transitioning to Loom. But at some point, it actually became simpler to develop all the infrastructure in-house. Sky Mavis did not rely on a third-party NFT marketplace and chose to implement their own version right inside the game. And in 2020, they dropped all plan to run on third-party L2s and simply created their own sidechain, Ronin, which is a semi-centralized Ethereum fork. This actually turned out pretty great for them, and they reduced transaction fees for their users to 0. And the tech investment wasn't too substantial, since forking Ethereum isn't very difficult. This shows us that infrastructure is becoming a commodity. Most of the value, the users, the revenue potential lies in the apps. And apps don't have a strong dependency on the infrastructure layer. If the fees aren't negligible, they can always run their own. This brings us to the paradox of blockchain monetization. Applications that require massive usage, have millions of active users and millions of transactions, will only run on platforms where the fees are practically 0. So platforms like Solana and Polygon do manage to attract massive usage, but they find it almost impossible to monetize this usage. They have to give the infrastructure for free. On the other hand, platforms that have high fees and generate high revenues are very limited in the amount of usage they can command. Take Ethereum, for example. It is mostly used by whale trading because of its high fees. So how do we solve this paradox? If the revenue potential is shifting to the application layer, we should focus on helping applications build and extract more value. We recognize 3 primary categories of applications today in crypto: DeFi apps, NFTs, and NFT gaming apps. Today, these apps monetize independently from the infrastructure. Can infrastructure protocol adapt to this reality? I believe they can, by introducing a new infrastructure layer on top of the L2. Let's call it L3. If the first infrastructure layer, L1, like Ethereum, is in charge of security, and the second infrastructure layer, L2, like Polygon, is in charge of scalability, The third infrastructure layer, L3, is in charge of helping apps build and extract more value. This layer provides services to applications and allows them to make the pie bigger, and thus receive a piece of the pie. I know that this is a pretty abstract concept, so let me give you a couple of concrete examples. The first example will be in the world of DeFi. One of the most successful DeFi apps is YEARN Finance. This app is sort of a decentralized hedge fund, where users can deposit funds inside vaults and let the vaults manage their money and create yield. Since the app directly generates profits to its users, it can allow itself to take a cut of the profits, and that's how it generates revenues. Some vaults, like Harvest Finance, take as much as 30% of the profit as fees. Overall, the strategies employed by these vaults are pretty simplistic, since they are all implemented as EVM smart contracts, and the EVM is very limited in its capabilities. Most vaults take LP tokens, simply stake them to get rewards, sell the rewards and buy more LP tokens, and compound the investment repeatedly. How can Layer 3 infrastructure increase the pie here? By implementing smarter vaults. Since the EVM is very limited and has access to very little state to base decisions on, vault strategies must be very simple. But imagine that you had an L3 that will let the vault developer implement much smarter strategies. For example, hop automatically between multiple positions depending on their APY. Or take a loan to add some leverage. This infrastructure will allow YEARN to generate better yields for its users, and therefore generate more revenues. This additional revenue can be shared between the application and the L3. Let's show another example in the words of NFTs applications. OpenSea is one of the most popular NFT apps. It's a marketplace where users can trade NFTs. One of the interesting features OpenSea added in the app layer is the concept of royalties. You can take some NFT and define a wallet that gets royalty every time this NFT is traded. This can be used, for example, for giving the original creator royalties over time. But what if we move this feature from the app layer to the infrastructure layer and allow paying royalties for any NFT in any marketplace? This would open up the door for many exciting incentivization models, like affiliate programs, that are very important for sustainable user acquisition. I'm one of the founders of Orbs, and Orbs is a blockchain infrastructure project. I'm very excited about L3 and looking forward to see L3 projects in DeFi, NFT, and gaming. I'm also very proud to announce that Orbs recently published its second call for grants and is offering grants and investment fund of up to $50 million for promising projects. Orbs is also part of DeFi.org Accelerator, which is co-sponsored by Binance. And we can really help accelerate your ideas. If you're passionate about value building and believe you can create infrastructure that helps make the pie bigger, don't hesitate to submit a proposal. Thank you.